Read. Everyone, heading is risk and leverage. Every business aims to improve the wealth of its shareholders, equity shareholders. Wealth of shareholders can be improved only when company generates good amount of profits. Here when they say profit, they are referring to EBIT. A continuously loss making company can never keep its shareholders happy. Obviously, simple sentence. To ensure that company earns enough profit, it should reduce slash control its cost. This is all applicable up to EBIT. Sales minus variable is contribution minus fixed cost is EBIT. For that, your cost control, cost reduction will help. After that, read important this. It is not sufficient to only earn enough EBIT. Company should earn so much EBIT that it is enough to pay its debenture holders or bond holders or bankers, that is debt fund, and also pay preference shareholders, that is preference dividend. After paying interest in between tax and then preference dividend, equity shareholders will get their returns. Which means, tell me, if I am an equity shareholder in a company, should I look at company's EBIT, say 10 lakh rupee, and get excited? Should I be happy looking at this number? No, what if interest itself is 12 lakh? Correct? Even if this is 10 lakh, tell me, as an equity shareholder, am I happy? No. Company is earning zero. Company is not in loss. EBT will be zero. But then as a equity shareholder, what am I going to get? Nothing. That means tell me which number I am supposed to check. Earning available to equity shareholder. If this number is positive 3 lakh, and if there are 30,000 equity shareholders, I am one among them, then I have a reason to be happy. That means it is not enough company is just earning positive EBIT. They should earn so much EBIT that they are in a position to comfortably pay interest and then taxes, and if there are preference shareholders, their dividend. All of this you pay, and then also some money should be available to equity shareholder. That means an equity shareholder will look at earning available to equity shareholder always and then decide whether this is a risky place or not. Imagine this number is 10 lakh and this itself is 22 lakh. Forget tax and preference dividend. Even to pay that extra 12 lakh interest, you may have to go for one more loan now, or you may have to sell some assets. Correct? Otherwise, where is the money? And interest is not one journal entry. You have to pay money. There is a cash outflow. If you made only 10 lakh profits and you have to pay 22 lakh interest, okay, all 10 lakh is gone. But where is the money for balance 12 lakh? Maybe old reserves you will use, or some assets you will have to sell, or you have to collect extra money from some debtors in advance now only. That means you are always doing that firefighting if your company is not even earning enough EBIT. Enough EBIT means what? The EBIT should be enough to pay interest, tax, and preference dividend. After that, also some positive number. If there is a positive number, then be happy. Your company's equity shareholders are going to get some return on their investment. Read. Note. Unless given in the question, assume that there are no preference shares. Most of the problems consider there are no preference shareholders. At intermediate level, lot of the sums you will see there is only either equity or there is debt, either insider or outsider. Because in many countries, preference shares are underlined considered on par with debt funds. What is the meaning of on par with debt funds? They believe both are alike, same. Tell me what is one common quality between these two? Debt and preference. They come with fixed rate of expectation. What is one difference between these two? Debenture holders rate of return is fixed and the timing is also fixed. You can't ask them to wait. But preference shareholders rate of return is fixed, but if you don't have money this year, they are ready to wait. At least in timing there is flexibility, not in rate. Here there is no flexibility in timing also and in rate also. That means debt is riskier than preference. In most of the countries, debt and preference shareholders are counted together because to both of them we have given a commitment and we have to pay. Continue. So most of the countries consider only two sources of funds. One is debt Another one is equity. The same approach is considered even in ICA study material for most of the problems. So if preference shares is not printed in the question, do not think what if there is a missing figure or a balancing figure. If it is there, it will be printed. Otherwise, there are only two sources. Lot of future topics in CA Inter FM, cost of capital, capital structure. That capital structure topic starts itself with an assumption there are only two sources of fund, either own money, that is equity, or outsider money, debt. There is no preference share capital discussed in most of the sums at inter level. So now what is risk? Risk is the variability in terms of actual return comparing with the estimated return. In simple, what is the meaning of risk? Whatever I am thinking that may happen, may not happen. If the chances of may not happen is more, that means risk is high. Chances of may happen is more, then risk is low. Correct? When I put money in bank FD and if I am expecting 6% return, there is no may or may not. I am sure it will happen. That means the risk is zero. That's why you call bank investment as risk free. Correct? Risk is possibility of things going against your plan. This high risk means high chances that it will go against my plan. The possibility of economy getting into depression, risk of extreme inflation, risk of not being able to achieve target profit, competition, so many things. Everything put together will create risk. You answer this question. Who takes the highest risk in a company? Equity shareholders. Correct? Definitely not debenture holders. I told you only two source. Don't bring preference shares in between. Why I am saying debenture holders won't take much risk? Two, three reasons. One, their interest is fixed number. There is no uncertainty. Second, timing also they are sure when they are going to get. Third, most of these are secured. So they know if you don't pay, there is a security asset attached to it. Fourth, when you wind up, you have to pay them first before paying to equity. That means if I am a debenture holder, I am in a much safer zone. And I will be paid, I means debenture holder will be paid before paying taxes. So even if government increases tax rate, as a debenture holder, I don't have to worry. But equity shareholder, will he worry if tax rate goes up? Yes, if 30% becomes 40%, equity shareholder will definitely feel bad about this. Because after that is his money. Think debenture holder has no reason to worry. He will get his money first and then government will get money. And if government also takes away more money, equity shareholder will be the last man waiting in the queue and his share will continue to come down. Answer is simple, equity shareholders. Let's learn then what are the types of risk, how do we calculate, and is there any benefit of taking so much risk? Why should anybody take risk? There should be some advantage. There are two components of risk. Risk faced by equity shareholder has two things. One, business risk. Second, financial risk. A small comparison is given here. Business risk, financial risk. Read both together. First one, it is associated with firm's operations and relates to the uncertainty about future underlying net operating income. In simple words, whether I will make positive EBIT or not. That risk is called business risk, also called as operating risk. Financial risk is the additional risk placed on equity holders because their company is using some debt funds. What does this mean? Think about this. Two individuals, Mr. A and B, both of them are running hotel. Both of them are paying 1 lakh rent. COVID came, lockdown was announced, 30 days, zero sales. Now, when there is zero sales, there is zero variable cost, there is zero contribution, but fixed cost rent will not come down. That means both these guys lost 1 lakh rupee negative EBIT, 1 lakh rupee negative EBIT. Both of them cried for 15 minutes together. They met and they cried. 15 minutes later, A stopped crying, B continued for another 15 minutes. When A asked, "What is wrong? I also cried enough now." 1 lakh crying 15 minutes is okay. Try to cry too much. Then B said, you don't know. I have taken loan. I have to pay interest also. Then tell me why A did not cry? Because he has not taken debt. Correct? Correct? That means both of them will face business risk, but only B is facing financial risk because he took debt. That is why in the text they said it is an additional risk. First, this nobody can avoid. Remember, both of them are crying because rent is to be paid even when contribution is zero. That cannot be avoided. There is always an operating risk in any business that you do. Don't think some businesses have risk, some businesses don't even have risk. Every business has its own variety of risk. We may not understand as a customer from outside. We think this guy is making good money without risk. That is not true. You start that business, you will understand. If any business has no risk, then everybody will start. Then competition becomes risk. Competition becomes reason for the risk. Correct? We may think, sir, this business almost no headache, but he makes super money. You also start then. That means there is some risk hidden in every business. We may not see from outside. Take a simple example. What is the risk of running a fruit shop? Just fruit, no fruit juice, only fruit shop. I buy, I sell. Correct? Damage, correct? Climate change. If you are not able to sell, then it may not be in a usable condition. And anybody can start another fruit shop next to you. That means competition is also very high. Correct? And suddenly rain and other things, people may not come out even to buy. Then your stock may become obsolete, and then entire 100 rupee you invested can come down to zero. That means a small business as fruit shop, flower shop also has its own risks. From outside, we don't understand. Unless we start another fruit shop, we will not get to know what risk they have. Correct? Now think about it. Cinema theater. I'll have to just add two more zeros. Cinema theaters are paying huge rent. Imagine 1 month, not even one good movie. Both theaters are under huge loss. That means both owners will cry. But then the second owner will continue crying for 15 more minutes because that guy has taken loan also. That means, can you escape business risk? No. Can you escape financial risk? Yes. Mr. A has escaped that financial risk. He did not take any debt. Able to follow? Sir, now I am understanding one more thing. What? If your company has high fixed cost and also high interest, then this is a deadly combination. Think, first of all, rent is high, fixed cost, example. Second, interest is high, and both won't change. Even if your sales is zero, fixed cost is there, interest is there. If you have both low, then you are in good peace. Imagine interest can be zero also. If you don't take loan, there is no interest. Think practically, can there be a business with zero fixed cost? Very rare. For discussion sake, we can say, sir, Pani Puri shop on footpath has no fixed cost. No rent, no asset, no depreciation, no salary, nothing. Correct? But those are few exceptions. If you are planning to set up a basic registered business, then you have at least some basic expenditures on monthly basis. If owner is not sitting in the shop full day, at least one employee, his salary is a fixed cost. Electricity bill has one fixed component in the total bill, at least that fixed component. And if you have at least one furniture, then there is some maintenance cost, some repair cost, some depreciation cost. That means theoretically we may discuss problems with zero fixed cost, but in reality, fixed cost will still be there. Can be less, but will be there. Can there be company with zero interest? There can be so many. You don't take loan, then there is no interest. Correct? That means nobody can escape business risk or operating risk, but you can escape financial risk. Escape or avoid or reduce. You don't want too much of risk. Don't want risk, then do not take loans. Financial risk. But this is not easy to escape. See this? How to measure business risk? You can measure it with a formula. Formula is called degree of operating leverage. DOL. Heading is operating risk, and we are measuring with operating leverage. Risk and leverage comes together. Correct? Leverage is the advantage gained because of the risk taken. Here, this is measured by degree of financial leverage. This is connected to economic climate. I told you, tight competition, government regulations, customers not liking that product itself. No problem with your business. Customers may not like that product itself. Today, you tell me, after OTT industry, cinema theaters are at big risk. Is anything wrong with cinema theaters? No. Theater is still good. Sound quality fantastic. Nice experience. AC is working. Then also people are not going to theater like how they used to go in 2017, 18, 19. What changed? What is the reason? OTT came. That means even if your theater is good, you may not be a successful theater owner. Your company may be in losses. Not because there is a problem with your theater. People have changed their habits. People are not coming out and watching movies. A lot of them have taken 3 year subscription during lockdown. That subscription is still on. Therefore, till that gets exhausted, they won't come out and watch. And nowadays, almost every movie is released on both places. And if same day they release on theater as well as on OTT, half of the people won't even go to theater. Movie is good, your theater is good, but people won't come. That is what they are saying. It is not always that your company did something wrong, so you are in loss. Maybe people's taste has changed. People may not buy your product, may not come to take your services. Have you noticed now? Correct me if I am wrong. I think it was Inox. Even they have now come with monthly subscription. You can pay some 999 rupee and you get 1 month subscription and you can watch 5 movies in that month. PVR is it? 349 rupee for 1 month. 5 movies, but challenge is Monday to Thursday only. You can't watch on Friday, Saturday, Sunday. That means you don't have to book a ticket. You'll get one card, just have to swipe and you are allowed to watch 4 movies. Now tell me, why are they doing? Because they've understood. People are liking this OTT type model that you pay once and watch whenever you want. What is the catch here for people who will be buying this subscription? 4 good movies should come in same month. Otherwise, you won't feel paisa vasool. That's a problem. Now, why PVR or Inox came to this point? Because they've understood people are not coming out and watching movie because movie is available on OTT. So even they shifted to OTT type of model now. But you still have to go. That means even if PVR is doing everything good, people may still not go. That is why I said nobody can escape business risk. Your business may be good, but people have changed their preferences. They are not coming and watching. But this financial risk is purely because of use of debt funds. This can be avoided. If you don't use debt funds, then you can escape this risk. How to reduce this? Every firm will have business risk due to change in overall economic climate and business operating condition. That means escaping this is not easy. A firm which is entirely financed by equity will have almost no financial risk. Such companies are called unlevered company. I have given a small note here. A firm which has debt in its capital structure is called levered firm, and a firm which has no debt is called unlevered firm. In a topic called capital structure, we will study this in much detail. As of now, this is enough. If I have debt, I have financial risk. If I don't have debt, then I don't have financial risk. But I cannot escape business or operating risk. Understanding? Now, the practical understanding of risk and leverage with numbers. Leverage means the advantage gained for any purpose. Study of leverage is essential to define the risk undertaken by companies' shareholders. Earning available to equity shareholders will fluctuate either because of operating risk or because of financial risk. Just now I discussed this theory in detail. All of you concentrate on the table. Illustrative example. I am not writing anything addition. Just focus on the data in table. I have taken case A as the base case for understanding purpose. And that A should be compared with B, A should be compared with C, A with D, and so on. First, I have taken sales as 100, Variable cost as 60% of sale, which is 60 rupee. Contribution is 40. Fixed cost 30. EBIT is 10. What I did in case B, 100 I made it 200. Now, can I say in percentage term, there is a 100% increase? 100% of 100 is 100. 100 plus 100 is 200. Now observe what will happen in the whole income statement. 60 will also become 120. Name itself is variable, it will vary in same speed. 40 will become 80. But tell me, this 30 will not change. Because of that, your EBIT 10 went up to 50 in Calci. Do it in calculator. How much is the increase in EBIT? 40 divided by what was the starting point? 10. 40 by 10 into 100. What is the increase? 400%. Correct? Now tell me, read the two numbers that I have written and tell me what conclusion you can make out of this. For 100% increase in sales, there is 400% increase in EBIT. In formula, if I write 400% divided by 100%, I get 4, and that 4 is called degree of operating leverage. Able to follow? 100% change in sales, 400% reaction in EBIT. Correct? Let's check with case C. Everyone, pay attention. 100 I made it 300. Now in Calci, please, how much is the increase? 200 divided by starting point is 100. 200 by 100 into 100. 200% increase. All okay? What will happen to variable cost? 60 will become 180. If you see this as 3 times, variable will also be 3 times. Contribution will also be 3 times. But fixed cost will remain there only. Now see, 10 became 90 in Calci. How much is the increase? 80. In Calci, do this. 80 by 10 into 100. You have 800% jump. Again, if I write in same format, see the next table. 800% reaction for 200% action. 800% by 200%, it is 4. Able to follow? Can you now tell me in your own words, what is this 4? What is the meaning of 4, please? What do you understand? What is the meaning of 4? For 1% change in sales, there is 4% reaction in EBIT. I repeat, for 1% change in sales, there is 4% reaction in EBIT. Let's see few more numbers. Case A, compare with D. Now you should do 100 goes up to 500. What's the increase? 400 rupee. Correct? Now 400 by 100 into 100 will be 400% increase. Because of this, 60 will become 300. Basically, 5 times. Contribution 40 will become 200. But your fixed cost 30 will remain 30. This number from 10 went up to 170. That means increase is 160 divided by 10 into 100, 1600%. Again, same style, 1600% reaction for 400% action. 1600 by 400% is 4 times. Correct? Now tell me, don't read case E. If one company has DOL 4 times, another company has 7 times, say this is A limited, this is B limited. Tell me, is a higher number better number? Observe, A limited has 4. You saw what is the meaning of 4. 1% change, 4% reaction. Assume this is A limited. Like this we worked out for B limited and answer came to 7. That means 1% change, 7% reaction. Tell me, is high number a good number? Is high number also risky? What is the risk involved if the number is high? Sir, you are only talking about 100 going to 200, 300, 500. 100 can go down to 20, 10, 0 also, no? Correct? That time 1% fall will result in 4% fall. because again that is 1:4. See case E now, everybody. 100 sales came down to 0. Tell me what happens now. How much is the decrease? 100% decrease. Able to follow? Yeah. 60 will become 0. Variable cost is always following the sales. Contribution will be 0, but 30 won't come down. Because of that, your positive 10 will become negative 30. How much is the fall from positive 10 to negative 30? 40 points. That means for 100% fall, there is 400% fall. 40 fall divided by 10 is the starting point. In all cases, A is the starting point. 40 fall divided by 10 into 100, 400% reduction. Now tell me, are you now understanding what is the danger of this 7 number? 1% change in sale, there will be 7% change in EBIT. Better to understand it as change than understanding it as increase, because it is both way. 10% up in sales, tell me what will happen? 70% up in EBIT. Following? But if sales come down by 10%, your EBIT will also fall by 70%. Imagine sale is up by 100%, your EBIT will be up by 700%. At the same time, if sale falls 100%, your EBIT will fall 700%. That means this number is both high risky and highly advantageous. Another company has 20, you will not have so much. Just for discussion, what is the meaning? 1% change, 20% up. 1% down, 20% down. That means if director sales next year, our sales will go up by 10%. In mind, you will multiply with 20. Suppose you are sitting in AGM and director gives a speech. In next 5 years, our sales will increase by 10%. In your mind, you are doing 10 into 20 times because your reaction is 1:20. That means big number is good if you are on the upside. If you are on a downside, even 1% fall will have a 20% fall. That is why topic name is risk and leverage. It both comes together. Following? Same thing is continued in the next table. See now, this is a very small table. We start with EBIT. Case A, let's assume EBIT is 100. Interest will remain same, minus 50. EBIT is 50. Now compare A with B. What did I do? 100, I changed it to 200. That means 100% increase. This 50 will remain 50. Because of this, 50 will become 150. In Calci, how much is the increase? 100 rupee increase. 100 rupee divided by starting point 50 into 100. Sir, this is increasing by 200%. Now tell me, if I do 200% reaction for 100% action, I get degree of financial leverage as 2. Why is it called financial leverage? Because this reaction is happening due to interest. Correct? Now, one small question. What if interest is 0? What will happen? Observe EBIT 100. Interest 0. EBT what? 100. 100 becomes 200. 0 is 0. This will be 200. Sir, this is up by 100%. This is also up by 100%. 100% by 100%. Financial leverage is 1. What is the meaning of DFL being 1? 1% change, 1% reaction. 1% up, 1% up, 1% down, 1% down. Less risky, almost no risk. Correct? Observe next case. 100 became 300. You have to compare A with C now. In Calci, please, 100 becomes 300. That means it is up by 200%. 200 by 100. Yeah. 50 will remain 50. This 50 will become 250. That means increase is 200. 200 by 50 into 100 is 400%. Again, what is the ratio? 400% reaction for 200% change. That means reaction is 2 types. 1% action, 2% reaction. High number means high reaction. Low number means low reaction. One more. 100 became 500. Now you can only take the answer directly without calci. What is the jump now? 100 became 500. 400%. And 50 became 450. That means 400 points increased by 50. 800 points. Sir, this is, sorry, not here. This is 400% change. This is 800% change. 800 by 400 is same logic should work reverse. Think now, if 100 becomes 0, pay attention, this is the danger area. 100 becomes 0, 50 won't come down. So positive 50 will come to negative 50. Now tell me 100 becoming 0 means 100% reduction. But 50 becoming minus 50 means 100 rupee fall. From positive 50 to 0. From 0 to negative 50. That means 100 rupee fall from a starting point of 50 into 100. That means there was a fall of 200%. Again minus 200 by 100 is 2. All okay? Now tell me two things we understood. If DOL is 3, please explain in your own sentence what is the meaning of this. For 1% change in sales, there will be 3% change in EBIT. Tell me if this number is very high in another company, it is both risky and advantageous. All okay? What is DFL is equal to 5? 1% change in EBIT. Remember, this is about financial leverage. 1% change in EBIT, there will be 5% change in EB. Able to follow? Everyone, the formula is summarized here. Please mark this full section as important. DOL is equal to, you can keep the previous page open for reference. How did we get that number? Percentage change in EBIT divided by percentage change in sales. Basically, reaction by action. This can be used when you have two period data, month 1, month 2, first half of the year, second half of the year, last year, this year. But if they give me single period data, only 1 month, then I can't use change by change. In that case, you can use the formula contribution by EBIT. Same way, DFL, what did we do in previous page? Percentage change in EBT divided by percentage change in EBIT. Again, use it when you have two period data. Any percentage change you have to do, you need two numbers. Last month, this month, correct? Here we can even use EPS in place of EBT. Very important. One thing you observe in income statement, everyone pay attention. Sales variable cost contribution minus fixed cost is EBIT. Can I say sales going up by 10%? Even variable will go up by 10%, contribution also will go up by 10%. That means these three go in same direction, in same speed. Correct? But fixed cost will go nowhere. It will stay there itself. That's why in EBIT level, reaction is more. That's why you saw 1% change, 3% reaction. Because one number is a stubborn number, straight line number, it won't move. After this comes what? Interest. Again, interest is a constant line. That is why your EBT will react too much. Notice this is what happened in our two tables. Sales went up, variable went up, contribution went up. Till that everything went up in same speed. After that one number stayed there itself. That's why all that extra reaction. EBIT also. EBIT went up but interest did not change. That is why EBT extra reaction. But tell me after this, tax, EAT, and then if you divide by number of equity shareholders, EPS, if EBT goes up, tax will go up, EAT will go up, EPS will also go up, and everything will go up in same speed. Understand? 100 rupee EBT, 30 rupee tax, 100 becomes 200, tax 30 will become 60. That means they will grow together, following same direction, same speed. The problem is these two numbers won't move. One is fixed cost, second is interest. Fixed cost is not moving, that is why it creates one risk, and that risk is called operating risk. Interest is not moving, that creates one risk, and that is called financial risk. Now therefore, tell me, I can, instead of saying 10% increase in sales, I can say 10% increase in contribution. Think, because if sales go up by 10%, variable also will go up by 10%, contribution also will go up by 10%. You saw in those 5 cases, 100 became 200, 40 became 80. Contribution also went up proportionately. If I can say these three here, I can say this here also. If EBT is up, tax is also up, EAT is also up, EPS is also up. Following, sir, business risk is because of fixed cost, financial risk is because of interest. If you are an equity shareholder, you are taking both risks. Correct. That is why it is called combined leverage. What is combined leverage? Combination of business risk and financial risk. And what is the formula? DOL into DFL. Observe, they said contribution by EBT. Why do you think they said contribution by EBT? What is the formula for DOL? Contribution divided by EBIT. And what is the formula for DFL, single period? EBIT divided by EBT. Now tell me, this and this can be cancelled. So what is left out? Contribution by EBT. Able to follow? Sir, how to remember this formula? Very simple actually. This DOL is all because of fixed cost. One number above fixed cost, one number below fixed cost. Now you only tell me. DFL is all because of interest. That means what should be the formula? One number above interest, one number below interest. I told you this extra reaction is only because of this number. And this extra reaction is only because of this number. That means formula is contribution divided by EBIT, and this is EBIT divided by EBT. And if you want combined leverage, EBIT is anyway common. You can strike off. Contribution by EBIT, EBIT by EBIT. Able to follow? Now give a try. What is the meaning if I say full sentence I want? If I say DOL is equal to 3, what is the meaning? 1% change in sales. I can say change in variable cost, change in contribution also. Correct? Okay. 1% change in sale will result in 3% change in EBIT. Correct? It is connecting sales to EBIT. Now if I say DFL is equal to 2, tell me what is the meaning? 1% change in EBIT will result in 2% change in EBT. All okay? And they are saying combined leverage is equal to this into this, DOL. See the text, you have the formula, DOL into DFL, 6. Now I want your answer. How to understand this 6? 1% change in topmost item will result in 6% change in bottommost item. Observe, see this. Sales to EBIT is DOL. EBIT to EBT is DFL. Now, if you are doing combined leverage, you are connecting topmost number to bottommost number, which is the topmost number. Sales, which is the bottommost number. EBT, and from EBT, everything will follow EBT. That means if EBT is up, tax is up. EAT is up, EPS is also up. Able to understand? You know how useful this is? Suppose one company has combined leverage of 10. Tell me what is the meaning? 1% change in sale will be 10% change in EBT. And I told you EBT, tax, EAT, EPS, everything will go in same speed. That means I can even understand this as 10% change in EPS. Imagine if I know this number and I am a shareholder sitting in AGM. If director says next year our sales will go up by 5%, what will I understand? 1% change in sale, 10% extra EPS. And if sales is up by 5%, my EPS will be up by 50%. I don't have to carry calci and do income statement in AGM hall if I know this number. I repeat, what is the meaning of what is the meaning of DCL 10? 1% change in topmost item. Sales, there will be 10% reaction in EPS. EBT, EAT, everything below is proportional. Correct? What is the use of knowing this? When I see in AGM hall on PowerPoint presentation directory showing next year our sales will be up by 5%. How will I understand for 1%, 10% is EPS extra? That means if sales jump by 5%, my EPS will jump by 50%. Same way, if director says there is too much competition, next year our sales will fall by 10%, then 10 into 10, my EPS will fall 100%. EPS falling 100% means what? EPS will come to zero. 100% fall means whatever you are will come down to zero. Able to follow? Now you tell me, big number is really good number? No, big number is a dangerous number. If you are on the downside, big number is a fantastic number if you are on the upside. Imagine one company DCL is 15 times. Sorry, DCL is 15 times. What does it mean? 1% change in sales, 15% change in EPS. And if there is 2% change in sales also, my EPS will shake by 30%. If it is upside, then I am super happy. If it is downside, then 30% fall. This year my EPS 10 rupee, next year 7 rupee. What if sales jump by 10%, sir? Sir, what are you talking? 150% jump. Same problem. Minus 10% will be minus 150%. So big number is not always good number. It is both risky and advantageous now. Did you understand? Combined leverage is DOL into DFL or contribution by EBT. Question number 5. A firm has sales of 40 lakhs, variable cost 25 lakhs, fixed cost 6 lakh, 10% debt of 30 lakh, equity capital 45 lakhs. Calculate operating leverage and financial leverage. Now to do DOL, operating leverage, I need contribution and EBIT. Correct? I do not have to prepare income statement every time. Please understand. We can do it directly with the formula. And is it single period data? That means I cannot do that percentage change. I have to use the other formula. Start. Question number 5. DOL is equal to contribution divided by EBIT. Contribution divided by EBIT. How to get the data for contribution? Do we know sales? 40 lakhs minus 25 lakhs. Correct? 40 minus 25 will give you contribution 15 lakh. And EBIT, I can write 40 minus 25 minus 6. Am I correct? What's the number? This is 15 by 9, 1.666 and so on. Correct? What is this? DOL. I need your help. What is the meaning of 1.66%? By the way, one second. Sorry. Don't write percent. Only 1.66. It is understood as percent. Please tell me what is 1.66 for 1% change in sales. There will be 1.66% change in EBIT. 1% up, 1.66 up, 1% down, 1.66% down. Which is the second number they want? DFL. DFL is equal to EBIT by EBT. Correct? EBIT we already have 9. Correct? To be divided by 9 minus interest will be 10% on 30 lakhs. 10% on 30 lakh will be 3 lakhs. That means 9 by 6 is equal to 1.5 DFL. All okay? What is the meaning of this? 1% change in EBIT, there will be 1.5% change in EBT. They have not asked, but I want you to try degree of combined leverage. How to do? Either I can do 1.66 into 1.5, or I can do using this formula, contribution by EBT. Correct? How much was contribution? 15. How much is EBT? 6. This will be 2.5. This you can do even from 1.66 into 1.5, but you will have a small difference because of the rounding off, because it is not exactly 66, it is 666 forever. There is no end. Because of that, you may get 2.499, which is okay, which is actually 2.5. Correct? I want you to tell me, what do you understand by 2.5? I'm writing one small class note. Please tell me what 1% change in contribution or sales. There will be, tell me what, 2.5% change in EBT, EAT, EPS. Everything? Yes. Listen, don't copy. I'll give you time to copy. What did you say? 1% change in sales, 2.5% change in EBT. Let's see. Originally, how much was sales? 40. You have it with you. Minus how much is variable cost? 25. How much is contribution? 50. Correct? From this, I have to minus fixed cost. What's the number? 6 lakh. If I minus this, I'm getting what now? EBIT of 6? No. Fixed is 6 and this will be 9. From this, I have to minus interest. Interest is 3 and therefore EBT is 6. Correct? And what are you saying? Sir, 1% change in sales. Correct? I will do one thing. I will do 100% change in sales. Correct? Tell me now, if 1% is going to impact 2.5%, then 100% should have an impact of 250%. Correct? Let's see now. Tell me 40 will become 80. This 25 also will become 50. Following, this will be 30, but this 6 will never change. This will be 24. This 3 will never change. This will be 21. In Calci, if you do 6 plus 250%, it should come to 21. The purpose of learning leverages is to avoid preparing income statement every time. You will be able to quickly process the data. If director says my sales is up by 100%, you will understand my EPS will be up by 250%. Otherwise, you have to carry Calci, book and pen to AGM hall. He says something you have to work out. To avoid working out is leverage. All okay? Did you understand properly? One second. Have you copied DCL also? Yes, better you copy this class note also. I'll wait. For 1% change in sales, for 1% change in sales, there will be 2.5% change in EBT. Done. Did you understand this table properly? I want to try to make sure our concepts are 100% clear. I'm making one small change. Everybody, try and help me. If sales are up by 20%, okay, what should happen to EBT with your 2.5? Please tell me, if sales are up by 20%, your EBT should be up by how much? 50%. Guys, 1 is to 2.5. 1% change, 2.5% reaction. For 20% up, it should be 50% up. Let's see. What is the meaning of 20% up on 40? 48. Able to follow? Just to make sure our concept is 100% clear. This 25 also will increase by 20%. What's the number? 30. This will be now 18, but this won't change, and this will be 12. This won't change, and this will be 9. In Calci, 6 plus 50% up should be 9. Hope you understood. This is the concept of risk and leverage. We can avoid preparing income statement every now and then if we understand the connection between change in one number and have the clear understanding of its impact on the other numbers. As an equity shareholder, I want to know what's the impact on EPS. But director in his speech may not say your EPS will change. He may say my company sales will change. You should be able to process the data faster. The purpose of leverage is to avoid preparing income statement again and again. And next time when you see a P&L account, if you are able to calculate this, then you will get to know whether it is high risky or low risky. Depends on whether DOL is high, DFL is high, combined leverage is high or low. Tell me that example which I told you, deadly combination. What was the deadly combination? High fixed cost and high interest. Tell me these kind of companies will have high DOL also and high DFL also. If both are high, then high combined leverage. Correct? That means these companies are high risky companies. Remember, 2 months for worst movies and for best movies. Your income can go up also like crazy and fall down also like crazy. This is the story, basic story behind risk and leverage. Done.